WeWork's public debut on the way, but lots of questions lingering about the company's structural and financials. Should you invest in the co-working giant when it hits the market? Want to bring in the Dans to discuss this. Axios editor Dan Primack is here. Dan Morgan, Senior VP and Portfolio Manager at Synovus Trust, also with us this morning. Mr. Primack, you have gone through this S1, and this is not like most S1s. What's your take?
No. It's incredibly complicated and in some ways kind of needlessly complicated, it seems. I mean, for starters, this is different than a lot of startup IPOs just because it's a real estate play, right? So you kind of always in real estate, you have a holding company and then another holding company on top of it. So that's going to be really complicated and the graphs and the charts look weird. But there's just some other stuff in there. And I wrote this yesterday. They're kind of needlessly complicated and are going to bother investors. And I think they're going to have to clean it up when they do kind of their amended filing right after Labor Day.
But Dan, clean it up how? Because there are some of the pages that talk about some of the relationships and things that happened in the past that frankly can't be cleaned up, but do raise lots of red flags.
I think they have to explain it. So, for example, there's this big, it's not even that big in the frame of WeWork, but this kind of $5.9 million payment that Adam Neumann, the founder and CEO, received from the company in exchange for the trademark We, which he had apparently trademarked before the company changed its name to the We Company, which is now its official name. They need to explain why, and they have to come up with a good explanation for it, and he probably has to pay it back.
That's the stupidest and a long list of stupid things I've heard coming out of this.
Well, that's sitting in there. I mean, the argument that I have heard from somebody is that he trademarked it long ago when he thought this would be WeWork would be one of lots of companies he'd create, and then eventually, you know, the value grew because the value brand of WeWork grew, so he had to sell it back, and there was tax implications. Doesn't matter. It's stupid. He should pay it back, and they should be really explicit on why it happened.
Leasing buildings that he owns from the company too. How is this not self-dealing?
I mean, that one I'm not as negative about. The argument that they make, which isn't a bad argument, is that it was 4 buildings, and they've got, like 550 at this point. They were all very early in the company's life, and at the time, WeWork was having a hard time getting long-term leases from commercial building holders because it was a new company, and nobody thought they were good credit.
Right. Hey, Dan, I mean, the other Dan in this case, is there a positive case to be made here on the operations of the business?
Yeah, I mean, it's a tough situation. Just, you're talking about some of the scrutiny that's going on involved with the founder of the company. And we're in a different environment right now, right? Because we know what's going on with the Federal Trade Commission and Justice Department on companies like Google and Facebook. But if you kind of flip it over and you look at, some of the valuations that are out there in regards to WeWork, I mean, they're going to be coming out at roughly about 25 times sales, which is pretty high if you compare it to, let's say, a Lyft or an Uber. That came out about 11 or 8 times sales. Again, this company is not profitable. It's just going to be very interesting to see how this company can navigate through, let's say, a more difficult economic environment and kind of matching their lease obligations with their member community leases. So to answer your question, Andrew, it is hard to find something in here that really stands out that's a huge positive, other than the fact that they've had tremendous revenue growth, right? They doubled their revenues, up 105%. In fiscal year 2018. So obviously they've got the growth on the top line. It's just trying to get through all the other stuff and get some sort of path to profitability.
But when you look at the numbers, do you say, okay, these numbers are not that they're better, that they're stickier numbers now that they're sort of focusing on the enterprise as opposed to the sort of random freelancer? This idea of effectively real estate as a service, which effectively is the model they've built.
Yeah, and they've added some technology companies through acquisitions. They use a term that sounds like software as a service, right?
Right.
It sounds like Salesforce.
Yep.
But in reality, they're still just, Andrew, their average commitment towards a lease is 15 years, and their average member community or enterprise customer commitment lease is 15 months. So, how do you match that out if the economy turns down? That's the real challenge for them, I think. So even though they've put some fancy terms on what they're doing and so forth, it's still a model that isn't overly complicated. There's a UK company called IWG who's doing the same thing that they're doing. It'll just be interesting to see how the street embraces this, whether it's a real estate company or a technology company.
Gentlemen, I have just a question more broadly, which is to say, how much juice is left for the average guy I'm looking here. Amazon went public with a market valuation of $400 million. Netflix went public with a market valuation of $300 million. A long time ago, but by the same token, one wonders, to the extent to which companies are staying private a lot longer than they come public, does this make a lot of sense for, let's say, the average individual investor to buy into this?
I mean, from my perspective, I mean, two things. First, we don't know the price yet, right? We don't even know the size of the float, so we don't know. But no, look, that's been an issue with kind of these mega unicorn IPOs that we've seen for the last couple of years now, and going back, last year, Dropbox, et cetera. A lot of that value has gotten sucked out by the private markets. There's no doubt about that.
We got to run, Dan. I apologize. You know what, Dan and Dan, thank you for this conversation.
Thank you.
Imagine we will have a lot more of it throughout September as we get ready for this IPO. Let me ask one question of Dan Primack before we go. Is there any chance you think this doesn't happen at all?
No, no. Outside of some, massive market crash, what we had last week, and get a bunch of that. No, I think it's going forward.
Okay.